Well, good afternoon and welcome to HYROX's weekly webinar where we will talk about what we see happening in the global economy and in financial markets and the world of wealth management and how all of this impacts our decisions on the best courses of action for our and your investment strategies. We invest our money in the exact same models as our clients, and we think that this defines the true nature of our prudent and disciplined investing strategy. Our discretionary management enables us to make quick decisions and execute them immediately for all of our clients simultaneously. This is especially important in volatile markets as we take advantage of opportunities that avail themselves to us. I'm Scott Tomlinson. My partner and colleague Paul Tepsich, the founder of HYROX, is not likely to be with us today as it is March break for him, but our financial planner and wealth forecast specialist, Bianca Tomlinson, is on the call. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. If you are a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the Private Client Division tab. Well, as we usually do, let's start with a quick review of our themes for 2017. We think that our strategy of having a tactical perspective to investing becomes even more important this year because of the even greater levels of uncertainty imposed on us by a number of developing factors. Inflationary expectations have been rising, and while much of the increases have been energy related over the last week, energy prices have fallen over 10%. The odds are over 90% that the Fed will raise interest rates by 0.25% tomorrow. And it is expected that earnings will grow at an approximate rate of about 9.8% in 2017. This has been lowered from 11.5% at the beginning of the year. However, valuations are at 14-plus year highs, suggesting a little too much euphoria in stock markets. Well, the Trump agenda appears to be running into hurdles. Scotland wants another referendum, and the Dutch and French elections are wildcards. I'll talk about that a little bit more as we go through the show. Well, one of the reasons that we desire a more tactical approach to investing over the old school buy and hold strategies is the changing nature of long-held correlations between stocks and bonds. Certainly in the United States that is the case, but it is also true in Canada. So we began our advanced approach to portfolio management back in 2015, and we added a third model to the standard buy and hold balanced portfolio of equity and fixed income to try and find a way to add value to client portfolios by reducing risk and maximizing risk-adjusted returns. Our style is to wait for opportunity and be tactical about how we take it. The benchmark equity index that we use for comparison has returned 16.32% from this time last year and only 5.69% annualized since this time 2 years ago. This emphasizes the volatility over this period of time. And meanwhile, the benchmark bond index has barely had any positive return over the past 1 and 2 years. And here is the combined equity and bond benchmark returns. Now look at the change in the 1-year balanced return over 1 week. Really volatile. Then look at how much less volatile the longer term returns are. There are significantly less week-to-week change. That is the important story here. It is not about the quarter-to-quarter or even year-to-year changes that matter. It is the long-term growth that truly does matter. And if we look at our HYROX client, the 1-year performance is now ahead of the benchmark, although it had been underperforming over the last couple of months. Now, that means that our client portfolios have a lot less volatility than the benchmark as a result of our tactical approach. And the long-term performance is well ahead of the long-term benchmark. Now that is our success, which in turn is our client's success as well. Of course, historical returns are no guarantee of future returns, but at HYROX, as you all well know, we work very hard to provide our clients with the best possible risk-adjusted returns. We also believe that it is crucial that we review your wealth forecast on a regular basis so that we can ensure that your long-term goals are in line with your portfolio strategy and our forecasts for your net worth into the future are up to date and heading in the same direction as your goals. Well, we are watching the inflation story closely. As all central banks have a mandate to maintain price stability, we are focusing on inflation as a key to determine if and when interest rate policy may change. Now, while total inflation data has been rising on a global scale recently, core inflation continues to remain below target levels. Nonetheless, the U.S. Federal Reserve is expected to raise interest rates after tomorrow's meeting of the Federal Open Market Committee. One of the reasons for higher total CPI has been the steady improvement in oil prices. Until this last week, however, when oil prices dropped by over 10%. Now, this volatility is why central banks like to take out the energy component from their inflation calculations to get a better read on what they call core inflation. What is now driving oil prices? Well, increased supply is one. While OPEC countries were cutting production into 2017, U.S. producers have been ramping up production, and now that increased supply has impacted prices. And commodity prices as a whole have also dropped, putting the reflation theme into some question. Add to this the weak forecast for U.S. consumer spending and non-residential equipment investment that have pushed expectations for GDP growth to significantly lower levels for the first quarter of 2017. With only a couple of weeks left in the quarter, this hardly looks like a good environment for higher interest rates. And stronger economic growth should help to grow federal revenue, but the U.S. annual budget deficit remained near its highest level in 3 years during February amid weaker growth in federal revenues. One big factor weighing on government finances is weak corporate profits tied to a sluggish global economy, a depressed energy sector, a strong dollar, and other factors. Government revenues declined 1.1% in the past 12 months compared with the prior year, while spending rose 3.8%. But the U.S. Federal Reserve has a dual mandate to seek full employment as well as to maintain price stability, and with good job growth in February, this is apparently enough for the Fed to raise interest rates tomorrow. On the week, U.S. bond yields have risen in expectation of a Fed rate increase. And in Canada, with improved full-time employment and rising U.S. bond yields, the Canadian yield curve has steepened. The Bank of Canada is not likely to raise rates anytime soon, however, so short-term rates remain low. With oil prices falling and higher U.S. interest rates, the Canadian dollar has been slipping towards the 70-cent U.S. dollar level. Well, speaking of Canada, the budget will be brought down by Finance Minister Morneau on Wednesday, March 22nd, which is next week. And while there are no certainties, it is expected that there are a number of deductions, credits, and favorable treatments that may be vulnerable as the government looks to find ways to increase revenue. And on the debt watch, last week we pointed out the risks of record amounts of global debt with rising rates. This puts increased pressure on debt servicing. And that in advanced economies, some countries have experienced rapid house price increases in recent years, including Australia, Canada, Sweden, and the United Kingdom. As past experience has shown, a rapid rise of house prices can be a precursor of an economic downturn. House price to rent ratios are at record highs in several countries and above long-term averages in many others. Although there has been a slower accumulation of household debt in recent years, mortgage debt to income ratios remain high in many countries, and Canada is certainly one of those. Well, as I mentioned in my blog this morning, margin debt, the money that investors borrow to buy stocks, is at record highs and is about to get more expensive when the Fed does raise rates. When the Fed removes liquidity from the system, financial institutions have a choice: borrow at higher rates or sell assets to increase their cash flow needs. If they sell assets, they will likely sell the most expensive ones. And speaking of expensive assets, let's talk about valuations for equities. Expected earnings for 2017 have been reduced from 11.5% year-over-year growth at the outset of this year to 9.8% now. For the first quarter, early expectations of a 12.3% year-over-year increase have been lowered to 8.9%. And looking forward, prices continue to outpace expected earnings. With lower earnings expectations and higher prices, the price-to-earnings ratio has jumped to 17.7 times, its highest level in about 14 years. Now, while the 10-year average is at 13.9 times. This means that earnings will have to grow by about 20% more than currently expected to bring the ratio back to its 10-year average, or the S&P 500 will need to correct by about 20%, or a combination of the two. At the moment, we don't want that kind of risk in our client portfolios. Another of our metrics of value, enterprise value to EBITDA, also shows stocks to be as expensive as they were at the time of the dot-com bubble. But retail investors have been piling into stocks with record flows into ETFs and mutual funds, and certainly that's a reason why prices have been driven higher. However, that may spell the peak in the cycle as emotions are also running high. Well, on the geopolitical front this week, repeated shocks have, the question is, are repeated shocks making investors numb to them? Volatility on stock markets has fallen while the uncertainty index on global economic policy has risen to new highs. And as we mentioned last week, Goldman Sachs Group Inc. Economists suggested investors are misinterpreting the political timeline, and with it, the market tea leaves. The strategists predict that President Trump will be tied up with repealing the Affordable Care Act, known as Obamacare, this fiscal year, leaving little room for tax reform and infrastructure spending. Goldman's timeline shows when the bank predicts these proposals will turn into some sort of policy action. The ACA will be a big focus until this summer, and tax reform could drag out into 2018. Infrastructure, meanwhile, doesn't even hit DC's radar until next year. And it appears that they may be correct with the new plan, as the number of Americans without health insurance would grow by 24 million under the House Republican proposal to topple most of the Affordable Care Act, according to a nonpartisan report from the Budget Office that is likely to complicate Republican lawmakers' efforts to unite around the plan. The rise in the number of Americans without coverage appears to contradict earlier statements by President Donald Trump, who has said everybody would be covered under a new plan. Well, on the Brexit front, Scottish First Minister Nicola Sturgeon says she will seek another referendum on independence from the United Kingdom, arguing that Scotland must choose whether it wants to be part of post-Brexit Britain or seek its own relationship with the European Union. And in the Netherlands, the election is seen as a test of far-right populism ahead of the national elections in far bigger European nations, France and Germany, where populists are also polling strongly. In the Netherlands, it's about what kind of coalition will run the country for the next 4 years and whether anti-Islam lawmaker Geert Wilders can win enough seats to force his way into coalition talks. And Dutch bond yields are showing us recent highs, which means there is some fear that that situation may become a bit more complex. Well, opinion polls currently suggest Marine Le Pen would be defeated in the second round, held on May the 7th, by Emmanuel Macron. Meanwhile, Francois Fillon was charged Tuesday, or today for that matter, with misuse of public funds, casting a permanent shadow over his bid to become France's next president. And French bond yields are also close to their recent highs. So here at HighRock, with all the upheaval, we will continue to monitor event risk and price valuation, and we will add or reduce holdings in our models as opportunity presents itself, and by preparing our strategies with continued deep levels of research, as we did last year, keeping in mind that our tactical approach allows us to add value and reduce risk to give us the best possible risk-adjusted returns. Well, as always, we want to thank you for taking the time out of your busy schedules to tune in. If you have any questions or concerns, please do feel free to email them to us. We will be back with our next update next Tuesday, but until then, this is Scott Tomlinson, and on behalf of my colleagues, Paul and Bianca, we want to wish you all a wonderful rest of the week.